In an age where information is increasingly digitized and vast amounts of data are generated daily, auditors need to adapt their methods to keep pace with these changes. In this lecture, we will explore the critical role of data analytics in auditing practices, demonstrating how it enhances audit efficiency, accuracy, and value. We will explore the significance of data analytics in auditing, its impact on audit quality, and the practical applications that are transforming the auditing profession. Data and analytics are two distinct but interconnected concepts in the realm of information and decision-making. Data refers to raw, unprocessed facts, figures, and statistics. It consists of individual pieces of information without any context or interpretation. Data is static and passive. It lacks inherent meaning on its own and requires interpretation and analysis. For example, a list of numbers is data. Without context or analysis, these numbers do not convey any information. In comparison, analytics involves the systematic processing and examination of data to discover patterns, draw insights, and make informed decisions. It's the process of extracting meaning and value from data. Analytics is dynamic and active. It involves using various techniques, tools, and methodologies to uncover hidden information, trends, and relationships within data. For example, suppose you have sales data for a retail store over the past year, including sales figures, customer demographics, and product categories. Analyzing this data could reveal that sales of a specific product category increased during a particular season, allowing the store to optimize its inventory and marketing strategies accordingly. In summary, data is the raw material, while analytics is the process of transforming that data into actionable insights. Analytics empowers organizations to make data-driven decisions, solve complex problems, and improve their overall performance. The auditing data analytics cycle is a systematic process that auditors use to apply data analytic techniques in the audit process. It typically consists of the following steps: data collection. Auditors gather relevant data from various sources, which may include financial records, electronic documents, and databases. The data collected should be comprehensive and reliable. Data preparation. Raw data is cleaned, structured, and transformed to make it suitable for analysis. This step involves removing duplicates, correcting errors, and ensuring data consistency. Data analysis. Auditors apply various data analytic techniques to analyze the prepared data. This analysis can include statistical tests, trend analysis, anomaly detection, and other methods to identify patterns or irregularities. Auditors then develop hypotheses based on the analysis and conduct further tests to verify or refute these hypotheses. For example, they might test the accuracy of financial statements or the effectiveness of internal controls. Reporting and documentation. Findings from the analysis are documented and reports are generated. Auditors provide evidence of their work and any identified issues or exceptions. Based on the results of the data analytics and other audit procedures, auditors reach conclusions about the accuracy of the financial statements, compliance with regulations, or any other specific audit objectives. The auditing data analytics cycle enhances the audit process by allowing auditors to examine large volumes of data more thoroughly and efficiently. It also helps in identifying anomalies, trends, and areas of risk that might be challenging to detect through traditional audit methods. Audit data analytics is a powerful tool in the risk assessment phase of an audit, helping auditors identify and assess risks more effectively. Common uses of audit data analytics for risk assessment audit procedures include identifying high-risk areas. For example, in a financial audit, data analytics can be used to identify unusual fluctuations in revenue. A significant unexplained drop in revenue might indicate a high-risk area that requires further investigation. In assessing fraud risks, auditors can use data analytics to analyze transaction data and look for irregular patterns or anomalies that might indicate fraudulent activities, such as unusual cash disbursements, duplicate payments, or suspicious vendor relationships. Data analytics can also help auditors detect unusual patterns or trends. For example, in inventory audits, auditors can use data analytics to flag unexpected inventory turnover patterns. A significant increase in inventory turnover might suggest a risk of obsolete inventory or potential misstatements in financial reporting. By leveraging audit data analytics for risk assessment, auditors can proactively identify areas of concern and allocate their resources more efficiently. This approach enables a more thorough and targeted audit, reducing the likelihood of overlooking critical risks and enhancing the overall quality of the audit process. Data analytics can also be used for segregation of duties analysis. For example, data analytics can help auditors analyze user access rights to critical financial systems to ensure that no one person has conflicting responsibilities. For example, the ability to both create and approve transactions. These types of incompatible duties could lead to fraud or errors. Audit data analytics is a valuable tool for conducting substantive tests during financial audits. Substantive tests focus on directly verifying the accuracy of financial statement balances and transactions. For example, auditors can use data analytics to compare the current year's figures with historical trends, industry benchmarks, or budgeted amounts. Significant deviations from expectations may warrant further investigation. Auditors can also use data analytics to perform an aging analysis. For example, they can use data analytics to analyze the aging of accounts receivable to help them assess the effectiveness of credit. Unusually long outstanding balances may indicate a collection issue. The use of audit data analytics to test the details of account balances helps facilitate a more detailed and efficient examination of financial statement items. These analytics help auditors identify potential misstatements, valuation issues, and discrepancies. For example, auditors can analyze expense accruals and provisions to assess whether they are adequate and accurately reflect liabilities. Unusual changes in these balances may signal issues. Regarding procedures to help auditors form an overall conclusion, auditors can use data analytics to perform trend analysis on key financial metrics over multiple periods. For instance, analyzing revenue growth rates, gross margin trends, or net income changes over several years can reveal patterns or anomalies that inform the overall assessment. Overall, the application of audit data analytics throughout these phases of the audit process enhances efficiency, accuracy, and the ability to uncover critical insights. It helps auditors identify risks, assess controls, and verify financial data more effectively, ultimately improving the quality of the audit and the reliability of financial statements. Auditors typically perform 5 steps when conducting audit data analytics, beginning with planning the audit data analytic through the evaluation of the results and drawing of the conclusions. These steps allow auditors to leverage data analytics as a powerful tool for enhancing the audit process by providing more in-depth analysis, efficient and risk-focused testing, and a basis for forming well-informed audit opinions. The initial step involves planning the audit data analytic. This step involves defining the objectives of using data analytics in the audit and determining the scope, resource requirements, and methodology. Auditors identify significant accounts and assertions, assess risk, and complete a comprehensive plan for how data analytics will be integrated into the audit process. Significant accounts and assertions play a pivotal role in the risk assessment process. Identifying these accounts and assertions allows auditors to focus their attention on areas with higher inherent risk. This focus helps ensure that the audit resources are allocated efficiently to address the most critical areas of financial reporting. Different accounts and assertions may require distinct audit procedures and data analytic techniques. By identifying significant accounts and assertions, auditors can tailor their audit approach, including the selection of appropriate data analytic tools and methodologies to the specific audit objectives and risk associated with each account. It is also important at this stage for auditors to plan how data will be collected and validated. Auditors need to ensure the accuracy and completeness of the data, considering issues like data integrity, data transformation, and data cleaning processes. They also must determine the appropriate data analytic methodology and technique to use. This decision should align with the audit objectives and the nature of the data. The second step, accessing and preparing data, involves gathering the data necessary for analysis, cleaning and structuring the data, and ensuring that it is suitable for the intended audit procedures. Auditors need to identify and collect the relevant data sources. This may include financial records, ledgers, invoices, bank statements, electronic databases, and other sources that contain information related to the audit objective. Once identified, auditors extract the data from these sources. This may involve using data extraction tools, scripts, or software to retrieve data from electronic systems. Auditors must ensure the completeness and accuracy of data extraction to avoid missing critical information. It is also essential to verify the accuracy and integrity of the data. Auditors must check for errors, inconsistencies, or anomalies in the extracted data. Verification may involve reconciling data sources, comparing totals, and validating the data against source documents. Data security and privacy are paramount. Auditors must ensure that the data is handled in a secure and compliant manner. This includes protecting sensitive data and adhering to data protection regulations. Data often needs to be cleaned to remove duplicates, correct inaccuracies, and standardize formats. Auditors may use data cleaning software or scripts to automate this process, improving data quality and consistency. Data may also require transformation to make it suitable for analysis. This can involve converting data types, aggregating data, and creating new variables or fields that are relevant to the audit objectives. Considering the relevance and reliability of the data used is crucial for auditors in audit data analytics for several reasons. Relevance ensures that the data being analyzed directly relates to the audit objectives. Using irrelevant data can lead to wasted time and resources. Auditors must focus on data that has a direct impact on the financial statements and audit assertions. Evaluating the relevance of data helps auditors assess the risk associated with specific data sources. Some data may be more significant in terms of financial reporting and materiality, and auditors should prioritize those sources in their analysis. Reliability addresses the accuracy and completeness of the data. Auditors need data that is free from errors, omissions, or inaccuracies. Inaccurate or incomplete data can lead to misinterpretations and incorrect audit conclusions. Reliable data is credible and trustworthy, enhancing the trustworthiness of audit findings and conclusions. Stakeholders, including clients and regulatory bodies, rely on audit results to make informed decisions. Using unreliable data can undermine the credibility of the audit process. Relevance and reliability are essential factors for maintaining the quality of the audit. Relevant and reliable data contribute to more accurate risk assessments, improved audit procedures, and more informed conclusions, all of which enhance audit quality. In the context of audit evidence, relevant and reliable data carries stronger evidential value. Auditors need data that can provide persuasive evidence to support their findings and opinions. Data that lacks relevance or reliability may be challenged by stakeholders. Several characteristics of data can affect their relevance and reliability in the context of audit data analytics. For example, source reliability. The reliability of data sources is critical. Data from reputable and trustworthy sources are more likely to be reliable, while data from questionable or unverified sources may be less reliable. Consistency is another example. Data consistency refers to the uniformity and standardization of data formats and units of measurement. Inconsistent data may lead to errors in analysis and interpretation. Timeliness is also an important characteristic. It is the degree to which data is up to date and reflects the relevant period under audit. Outdated or delayed data can impact the relevance of audit procedures. Overall, auditors must thoroughly evaluate characteristics of the data to assess the relevance and reliability of the data used in audit data analytics. Ensuring that the data meets important criteria is essential for maintaining the integrity and quality of the audit process. The next step involves auditors' analysis of the prepared data. This step includes performing tests, comparisons, calculations, and visualizations to uncover patterns, anomalies, and insights. Auditors may use statistical analysis, regression analysis, trend analysis, and other methods to evaluate the data in line with the audit objectives. If auditors find that initial results from an audit data analytic need to be revised, it is essential to take corrective actions promptly to ensure the accuracy and reliability of the analysis. Auditors should reevaluate the data used in the analysis. This could include checking for data quality issues, ensuring that the data is complete and accurate, and confirming the relevance of the data to be audited. They should also examine the data analytics methodology and techniques used in the initial analysis. Ensure that the methodology is appropriate for the audit objectives and that it is correctly applied. Consider whether alternative or additional methodologies may be more suitable. Reanalyze the data using the revised methodology and data. Ensure that the revised analysis addresses the audit objectives and provides reliable and meaningful results. Revising the audit data analytic is a standard practice in the audit process when initial results indicate the need for improvement. Auditors must focus on maintaining data accuracy, reliability, and relevance to provide reliable audit findings and conclusions. The final step of evaluating audit data analytic results and documentation procedures involves assessing the outcomes of the data analytics process and ensuring that the audit work is well documented in a comprehensive and organized manner. In this step, auditors evaluate the outcomes of the audit data analytics. This includes a careful review of the data analytics results, findings, and any anomalies or exceptions identified during the analysis. Auditors assess the relevance and significance of the data analytic results in the context of the audit objectives. They consider whether the results provide meaningful insights and support the audit assertions. Auditors review how well the data analytics results align with the audit objectives and assertions. They ensure that the data analytics procedures have addressed the intended areas of risk and materiality. Auditors use the insights gained from data analytics to form conclusions about their financial statements and their compliance with relevant accounting standards and regulations. Audit documentation is also a critical part of the audit process. Auditors must thoroughly document the entire data analytics process, including the objectives, data sources, methodologies, results, and conclusions. This documentation ensures that the work is well documented, transparent, and compliant with auditing standards. The findings and insights obtained through data analytics are then incorporated into the audit report, helping to communicate the results to stakeholders.